Hello and welcome back to Channel 11. I'm your host Ken Shinoda. Today is Wednesday, October 1st. We're going to review September. The government shuts down, stocks melt up, and bonds, they carry on. Here we see the land of gain continues. It's like April was just a bad dream. Stocks keep melting up to new highs here, up in the almost 6,700 on the S&P, way above the 200-day moving average. Looking at the mix of equities on the month, information technologies, communication services, and growth stocks doing the best. The momentum keeps moving, and lagging is energy, consumer staples, materials. Year to date, it's IT, communication services, and industrials up there with growth at 18 to 20% return. So turning out to be a higher return for the S&P than the market expected. I think a lot of equity analysts thought we'd see kind of like a 6-7% return, and here we are in the teens yet again. So those that doubted the USA should doubt away. Here we go, Mag 7 making a huge comeback from April, near all-time highs now. And what that's doing is making the market cap weighted S&P have a big comeback against that equal weighted. One of the themes a lot of people were talking about was how so much of the S&P's return is a few stocks, that the rest of the market would catch up, so be equal weighted. I kind of like that trade too. It worked for a little bit, but guess what? Sticking with those winners, the winners keep winning. It is amazing how much those mega caps are leading the way higher. Looking at the speculative fervor monitor, Bitcoin, not at all-time highs, but has made this new kind of like 110 to 120K range. Some of the other crypto coins not doing so well. Ether was down a bit. Here you can see Dogecoin kind of languishing. But then as we look at Tesla and ARK, they are making big comebacks as well. So it's been a big run up in some of those 2021 type trades, except the NFTs are not making a comeback. The what are those? The gorillas or the monkey coins or whatever they were, those are not winning. Those are still down in the dumps. Here we go with semiconductors, the big AI spend also making a comeback here. Not quite back to the highs, but all these charts kind of look the same. Sold off into April and everything kind of making a comeback. Looking at the Trump trades, it's kind of a mixed bag. Small caps have made a big recovery as the market expects the Fed to cut. Financials also good recovery as you see net interest margin and the yield curve improving. But one of the Trump trades to start the year was that inflation was going to pick up, and you saw 10-year Treasury yields rise. They've come down now with the market expectation of Fed cuts and also people worrying about the jobs market. So 10-year Treasury yields on the lower end of the trading range, and with yields lower, the dollar has also weakened now to kind of the low end of the trading range that we've seen recently. Looking broadly more across global markets, month to date, the Nikkei, NASDAQ, and emerging markets, the big winners. EM, a lot of people doubted. That turned out to be the big winner this year. Local currency is winning, up 26%. European and U.S. equities and Japanese equities, all kind of in the mid-teens, also doing well. The laggard there looks like Dow Jones Transports, Dow Jones Industrials, generally speaking, and also the Russell, but still up 10%. So won't cry about that. International equities, again, it's been a good run. But the U.S. has caught up. So as we look at the kind of make Europe great again or mega trade, we saw a big win into kind of the summer, and now the U.S. has been playing catch up. So Europe's still doing well, but the USA not too shabby as well. Dollar index, we looked at this a couple slides ago, lower end of the trading range. We still like diversification out of the dollar. You can do that through international equities, emerging market equities. You can do that through non-dollar denominated fixed income, through global bonds or local emerging market currencies. You get paid a little bit more yield in those local market emerging markets. I think the index is closer to 7 there versus global bonds, lower yield, longer duration. So we've been moving in some of our strategies into more non-dollar denominated fixed income, and it's been working. We think it's going to continue to work. Here's that chart of the euro post the election. We put it on top of the 2016 experience, and it is just so creepy how closely it's been followed. So looking for the euro to maybe appreciate a little bit more here against the dollar up into that 125 range is where some research and market participants think we may go to, not so far away. The yen has had some trouble rallying below this kind of like 140 area, and it's cheapened up a little bit back to that kind of like almost 150 area. And it's been a decent buy up in that kind of 150 to 160 area. So if you are looking to travel to Japan, a lot of people are going there. I saw like 40 plus million travelers, I think this year. So buy some yen for that trip. Maybe a good time here. All right, commodity index. It's kind of going sideways, but if you look under the cover, it is a mixed bag, and metals, precious metals are really leading the charge. It's been absolutely crushing it, almost up 50%, kind of crazy. Silver up almost 60, and then you can see outside of livestock, everything else is kind of flat. I guess copper's had a good run, up 20%, and this is why the index doesn't look like it's going up too much, because the index has more natural gas, which is actually down on the year in there. So really kind of a crushing time for precious metals. A lot of talk about that 25, 25, 25, 25 portfolio, 25% stocks, 25% bonds, 25% gold, 25% cash. It's been working. What's going on out there economically? Growth expectations have been going up. We had a revised Q2 GDP surprise to the upside. But market pundits keep increasing their growth expectations. Here's Atlanta GDP now, as you can see, nearing the highest levels so far. Manufacturing hasn't improved. We got a new number today up at 49, so this is a day stale. Still sub 50, but improving. And services just keeps chugging along. Consumers out there spending. We can see that when we look at retail sales, still positive. So the consumer is still keeping the economy alive. Manufacturing has been languishing, but services, which drives most of the economic growth in the U.S., still seems strong. Now, why is the Fed cutting while inflation remains high? They're looking at the job market. There's been some revisions in jobless claims into the summer. I think this is what the Fed was looking at when they decided to have their what they called a risk management cut. And they were also looking at non-farm payrolls. So if you go back pre-2020 or pre-COVID, you can see like the kind of normal level of job creation was in that kind of 150,000, 200,000 jobs type level. And we had that big spike after COVID as people left the workforce and then they came back. We normalized back to that kind of like 150, 200K level. And now we've been dropping pretty dramatically sub 50K. And this is, again, one of the reasons the Fed had their risk management cut. Now, I think one of the things to think about, and we've been noodling on here at DoubleLine, is are we in a new hiring regime where because of immigration, because of demographics, baby boomers leaving the workforce, their stocks are up a lot, as we saw in the land of gains, their houses are up a lot in price, maybe time to not work anymore, enjoy your retirement. So they leave the workforce, immigration's down. Maybe this is the new normal of a low hiring, low firing market. And so I think the Fed did their cut because they're worried about this, but maybe this is the new normal. So we have to wait and see how this data plays out. Although with the government shut down, maybe we won't get data. What are we going to do? We're going to have to wait. In that instance, maybe that's going to be a shaky time for equities. And that's why bonds could be interesting, because you just get to clip your carry and hang out, and if things slow down, bonds should do well. So look at what's going on with Fed funds, a big drop in the market's expectations of Fed cuts from the beginning of the year going into 2025. We thought we'd end 2026 up in the kind of mid to high threes, and now the market thinks we'll be all the way back down to 3%, which is the neutral rate based on the Fed's dot plots. So what's happened? We've had a pretty good rally across the curve outside of the long end. The long end lagging a little bit, so a big steepening of the yield curve. We've been a fan of the yield curve steepener, and you can see it steepened pretty dramatically. It was negative 1%, 100 basis points for 2s 30s, and now we're over 100 basis points on 2s 30s with maybe some more room to run, especially if there's concerns around fiscal. You can see that long end sell off. If the economy slows, the front end should fall as the Fed cuts. So we like having that positioning on that 2s 30s steepener. Now, I've had a lot of questions from investors about the Fed's independence. Is the Fed still independent? Well, I think they still are for now. They could get less independent. I don't think they're going to be non-independent. I don't think the government's going to control them. But if Trump puts in his person as the Fed chairman next year, people are worried that the Fed could lose its independence and inflation could rear its ugly head. What should you watch out for that? Well, just avoid the long end. Stay away of those long bonds, and that's why we've got that steepener on. But watch the inflation break-evens. This is the market's expectations of inflation based on the pricing of TIPS, Treasury inflation-protected securities. And so far on the left-hand side, you can see that the market isn't really worried about runaway inflation like it was in, let's say, 2022. You saw a spike as we started hiking rates, but you saw a little bit of a spike in the 2-year inflation expectations with the tariffs, the tariff tantrum in April. That's come back down a lot. So I would watch this as a sign of the market fearing the lack of Fed independence, as if you see the market expectations of inflation run away. For now, they're not worried about it. And you can see that also on the long end of the Treasury yield curve. All right, fixed income. Last month, pretty solid returns. Better for fixed than floating. Floating rate lagging, especially risky floating rate stuff. Triple C, bank loans only up 10 basis points. Everything, the fixed rate, safer stuff that has longer duration, up almost 1.5% for corporate bonds. The index up 1.1. Now the ag is up through September, 6.1%. Who would have thought? There was a moment where rates were backing up, people were spooked, didn't want fixed income, but it's been a decent place to be. Returns similar to long-run equity returns, high yield returning 7%, the ag returning 6%, agency mortgages making a big comeback, up 6.8%. Really floaters lagging with AAA CLOs up only 4%, and the bank loan index up only 4.7%, but 4.7%, not too shabby either. So it's been a year of winning for your PA if you just close your eyes and didn't freak out in April. Seems to be the a theme to don't freak out. Easier said than done. But I like to just never sell and just buy the dip is how I think about my long-term PA. Now, looking at spreads are getting pretty rich. Here are investment-grade corporate bond spreads near decade-long lows on the investment-grade corporate bond index in the low 70s. High yield got it to 250 earlier this year. Now we're at 267, grinding tighter. But some of the securitized sectors, and we've talked about this so many times, they're cheaper and they're going to get less cheap as the market moves there for relative value. We're seeing that continue. A lot of insurance money chasing the extra spread, higher yields. You get paid probably sub 100 spread to buy triple B type risk. Double Bs, I think, are in the mid hundreds, and you can still buy securitized investment grade bonds 100 to 200 spread. So there's value there. We're taking advantage of that across the board in our strategies. It's a way you can get access to that. But I think the corporate bond market is going to lose some steam here, and the securitized markets are going to catch up. Could be a shaky October. October is seasonally one of the more volatile times of the market. Maybe stocks go sideways, maybe they go down a little bit. But I think that in that market, bonds could do okay. So good luck out there, and we'll see you next time on Channel 11.